When you are over 50, fear changes shape. It is no longer the fear of whether you can make money someday. It is the fear of whether you waited too long. The fear of whether the years you still have are enough. The fear of whether every article, every video, every lecture, every cheerful financial expert talking about 30 or 40 years of compounding is speaking to a younger version of someone else and not to you. I understand that fear. I have spent most of my life studying money, capital markets, businesses, human behavior, and the way fear changes its clothing as people age. A young man fears he will never get started. A middle-aged man fears he may have started too slowly. An older man fears that one serious mistake near the finish line can undo a great deal of discipline. These are different fears. They require different answers. And if you are over 50, the answer is not complexity. That is one of the first things I would tell you. You do not need 15 funds. You do not need a watch list large enough to make you feel busy. You do not need to become a stock picking hero in the evening after work. You do not need to turn yourself into a part-time economist, part-time trader, part-time analyst, part-time prophet, and full-time insomniac. That is not a retirement plan. That is a new form of stress. What you need is a structure strong enough to do two things at the same time. It must still grow, and it must still protect. Most people over 50 fail because they lean too hard toward one side and ignore the other. Some become so frightened that they try to protect every dollar from volatility and end up guaranteeing a slower erosion through inflation. Others become so desperate to catch up that they swing too hard for growth and leave themselves vulnerable to the worst form of bad timing. A market collapse arriving just when they were counting on stability. That is the real balancing act: offense and defense, growth and protection, ambition and survival. This is not glamorous. But then again, almost nothing genuinely useful in finance is glamorous. The world sells glamour because glamour is easy to market. The world sells simplicity in the wrong places and complexity in the wrong places. It tells young people that investing must be exciting. It tells older people that investing must be terrifyingly sophisticated. Both ideas are wrong. What I have learned after all the balance sheets and all the cycles and all the booms and busts and all the fashionable nonsense that has come and gone is that a good financial life is often built on simple structures carried out with extraordinary consistency. That is why I like broad ownership and ballast. Broad ownership for growth, ballast for stability. A great many people over 50 do not need a magician. They need a machine that works while they sleep, a machine that does not require a new opinion every Tuesday, a machine that still lets them own the productive power of American business without requiring them to guess which one company will dominate the next 15 years, and a machine that also lets them survive the periods when markets stop behaving kindly. That is why a simple two-fund structure can be so powerful. Not because it is clever, because it respects reality. The first part of that reality is that you still need growth. This is one of the great mistakes people make as they age. They begin speaking as though 50 means the game is nearly over. That is not how life works anymore. Many people over 50 still have 15, 20, even 30 years ahead of them. That is not a short period. Inflation does not stop because you are approaching retirement. Healthcare costs do not freeze out of respect for your age. Property taxes do not look at your birth year and say we should be gentler now. The cost of living keeps moving. So if all your money sits in places that merely look stable, but do not grow enough to outrun the quiet theft of inflation, then you may protect the statement and lose the life. That is a very expensive misunderstanding. Cash feels safe because it does not move much in nominal terms. But money that sits too long without working loses power slowly and politely. That politeness is what makes it dangerous. People think danger has to look violent. Very often danger is just steady erosion presented in a respectable tone. That is why I would still want a meaningful portion of a retirement portfolio in equities, even after 50. Not because I am reckless, because I respect time and inflation. A broad U.S. stock market fund like VTI is useful because it turns one of the hardest investing tasks into something ordinary people can actually survive. It removes the need to pick winners one company at a time. That is a tremendous gift. Most people overestimate their ability to identify the next great stock and underestimate the damage done by being wrong with confidence. When you buy the total U.S. stock market, you are not making a narrow bet on one idea or one executive or one story. You are buying participation in thousands of companies at once. You own technology, you own industrials, you own healthcare, you own financials, you own consumer businesses, energy firms, transport, software, manufacturing services, and all the rest of the messy, productive, constantly changing organism we call American business that matters. Because ownership is a different mental posture than prediction. Prediction says, I know what the future will favor. Ownership says, I know productive enterprise will continue creating value over time, and I would like my capital attached to that process. I have always preferred ownership. The total market does not ask you to become a genius. It asks you to remain patient. That is much easier and much rarer than people think. Now, why VTI rather than trying to build a list of 5 or 10 favored names? Because age should not push you toward unnecessary fragility when you are younger and have decades to recover from your own intellectual vanity. Perhaps you can afford to learn some lessons the hard way over 50. The price of self-flattering mistakes rises. A broad fund solves the biggest problem ordinary investors have, which is not lack of enthusiasm but lack of durable edge, and it does so cheaply. Low fees matter more than almost anything in long-term compounding because fees are among the few losses investors volunteer for every single year. A little friction repeated long enough becomes a very large surrender. That is another reason I prefer low. Cost broad ownership over expensive cleverness. You do not need to donate 1% or more every year to someone with a polished pitch and a handsome brochure if the broad market will do the heavy lifting for a tiny fraction of that cost. Costs matter. They always matter. The problem is that VTI alone is not enough for someone over 50. This is exactly where many people get seduced into a dangerous half-truth. They hear that stocks build wealth, which is correct. They hear that over long periods the stock market has rewarded patient owners, which is also correct. Then they commit the oldest sin in personal finance. They take a true statement and extend it past the point where it remains wise. Yes, stocks build wealth, but if the market falls hard 3 years before you retire and you have no stabilizer, then the math that looked wonderful at 40 becomes much more dangerous at 62. This is called sequence risk, though the phrase sounds drier than the pain it creates. The danger is not merely that stocks can go down, of course they can. The danger is that they can go down at exactly the wrong time, when you are close enough to retirement that a large drawdown changes not only your statement balance but your actual choices. A younger investor can often absorb a 30% decline and wait. A retiree or near retiree who needs to withdraw money may not have the luxury of waiting gracefully. That is why the second fund matters so much. And in many ways, for someone over 50, it may matter even more. The second fund is not there to impress you. It is there to protect your right to stay rational. That is what a high-quality bond fund does. A fund like BND, the total bond market, acts as ballast. I like that word because it describes the job accurately. Ballast is not there to make the ship exciting. It is there to keep the ship from rolling over in bad water. Modern investors have become a little too addicted to excitement and a little too dismissive of ballast. They hear the word bond and think old-fashioned. They hear a lower return number and think unnecessary. This is shallow thinking. The right question is not whether bonds will outperform stocks over the next 20 years, in some abstract sense. The right question is what role bonds play inside a real human life that includes fear, withdrawals, market shocks, rebalancing opportunities, and the need to remain psychologically intact when the stock market stops being friendly. BND owns a large slice of the high-quality U.S. bond market. Treasuries, mortgage-backed securities backed by agencies, investment-grade corporate debt. It is not trying to be exciting. Good exciting is what causes so many people to overpay for stories they do not understand. BND is there for a different reason. When panic hits, high-quality bonds often behave differently from stocks. Not always perfectly, not in every episode, but often enough and meaningfully enough that the total portfolio becomes far more survivable. That survivability is what matters. I have watched countless people do the wrong thing because their portfolio asked too much courage of them at the worst possible moment. A man with 100% stocks can feel very brave in a bull market. Courage is cheap when the tape is green. Then the market drops 30 or 40% and suddenly all the little speeches about long-term conviction become more difficult to deliver. That is when people sell, not because they lacked intelligence, because they lacked structure. A person with a balanced portfolio often sees a smaller decline. That difference is not cosmetic, it is behavioral. A 20% decline feels very different from a 40% decline. The second may make a person abandon the plan. The first may merely make him uncomfortable enough to complain over dinner. Uncomfortable is survivable. Panic is expensive. This is why I like bonds as stabilizers. But that is not their only job. They are also ammunition. This is where sophisticated investors part company from casual ones. The casual investor sees bonds as dead weight. The sophisticated investor sees them as a reservoir of optionality. If stocks collapse and bonds hold comparatively better, then the investor with bonds can rebalance. He can sell some of what held up and buy more of what fell. He can buy low without requiring cash from outside the system. He can convert market pain into a disciplined action instead of a psychological trauma. That is a marvelous feature. It is one of the great overlooked advantages of holding high-quality bonds in a retirement portfolio. They do not merely reduce volatility. They give you something to do when the rest of the world is becoming emotional. And good investing is often simply the act of remaining useful while everyone else becomes emotional. Now, the correct mix between VTI and BND will vary. I do not believe in pretending that one number fits all souls equally. A 51-year-old with a generous pension, low living costs, and a strong stomach is not the same as a 62-year-old with no pension, high expenses, and the sort of temperament that loses sleep over every market headline. Still, a simple rule can help. A good starting point is to take 110 and subtract your age. The result becomes your stock allocation. The rest goes to bonds at 50. That suggests 60% in stocks and 40% in bonds. At 60, it suggests 50 and 50 at 65, 45 and 55. This is not divine law. It is a practical glide path. And glide paths matter because they recognize a truth many people would rather ignore. As retirement gets closer, capital preservation and emotional survivability deserve a larger seat at the table. You do not have to become cowardly. You do have to become a little more respectful of timing risk. The beauty of a simple rule is that it makes adjustment easier. It creates discipline where otherwise people would substitute impulse. A person sees the market roaring and thinks perhaps I should go more heavily into stocks because I am feeling optimistic. Then the market stumbles and he thinks perhaps I should run to cash because this is frightening. This is not portfolio management. This is mood management, pretending to be intelligent. I want rules strong enough to govern people when their own feelings are trying to misprice the moment. A glide path does that. It lets the portfolio evolve with age without requiring constant reinvention. And because the rule is simple, it is easier to actually use. That matters a great deal. A mediocre system used consistently is often better than a more perfect one ignored whenever life gets busy. Now, some people over 50 tell me they do not even have $100,000 yet. They hear these examples and begin to feel shame. Shame is useless here. You do not need $100,000 to begin. You need a system. The math scales. $300 a month matters. $400 matters. $500 matters. The person starting later cannot afford to worship perfection. He must worship consistency instead. I have always found it fascinating how many people refuse to start because they cannot begin at the ideal level. That is vanity disguised as practicality. A person says, I cannot save enough to matter, so I do not save at all. He says, I cannot build the portfolio. I should have built at 30, so why bother now? He says, I am embarrassed by how small the beginning looks, so I will wait until I can begin in a way that flatters my pride. That is how time gets wasted. And time is less patient with the over 50 investor than with the 25-year. Oh, this is exactly why simplicity matters. If you are over 50 and still building, you do not need more friction. You need fewer places to break the habit. That means automatic contributions. If the money never reaches your checking account in a psychologically available form, it cannot be spent in a moment of fatigue or self-justification. Automation is not glamorous. It is one of the most powerful inventions in personal finance. It removes daily heroism from the process. And daily heroism is a poor foundation for a long retirement plan. You are tired. Life is full. You have responsibilities. The children may still need things. Parents may need help. Work may be draining. Health may occasionally be impolite. This is not the season of life where I want your success to depend on a fresh burst of virtue every month. I want the structure doing the heavy lifting, set the allocation, set the contribution, increase it when income rises, rebalance annually. Then let the machine work. That is the strategy, and because the strategy is simple, it has a much better chance of surviving real life than the beautiful, overly intricate schemes people love to design when they are imagining perfect future versions of themselves. Another mistake older investors make is checking the portfolio too often. This sounds harmless. It is not. A retirement portfolio is not a weather app. It does not improve because you stare at it more frequently. If anything, frequent checking increases the odds that you will interfere emotionally. You see the red day. You feel the need to act. You see a strong rally. You feel either euphoric or regretful. Neither feeling is useful. The market was not designed to be watched like a hospital monitor by ordinary people trying to retire with dignity. It was designed to fluctuate, and if you invite those fluctuations into your emotional life every day, the portfolio stops being a plan and becomes a source of stress. I would much rather a serious investor check the allocation occasionally, rebalance when appropriate, and otherwise get on with the business of living. This is another reason I like VTI and BND. They are not built for drama. They are built for endurance. That is a much better quality at this stage of life. I also want to say something about income because many people over 50 think the only valid retirement strategy is one that throws off visible cash every month. I understand the desire. Income feels real. It feels safer. But a good retirement system should not be built merely around the emotional comfort of seeing cash distributions. It should be built around total return, preservation, flexibility, and your actual spending needs. A broad stock fund plus a broad bond fund can create income in several ways. The bond fund yields, the stock fund pays dividends, and the total portfolio can be rebalanced and drawn from intelligently over time. You do not need to chase the highest yielding products in the market and load your future with sector concentration just because the distribution rate looks comforting today. That is a very dangerous habit. High yield is often compensation for hidden weakness. I prefer durability over temptation. The point is not to maximize visible monthly income at any cost. The point is to preserve the engine so that it can support you for the full stretch of your later life. A portfolio that earns slightly less visible income but is far more robust can be vastly superior to a portfolio built around the emotional desire to see a bigger monthly deposit. Again, the right structure matters more than the flattering sensation. Now let me tell you what I like most about the two-fund approach for someone over 50. It reduces the number of ways you can lie to yourself. That is not a small feature. A complex portfolio gives you endless excuses. This fund underperformed because of the cycle, that one because of rates. This thematic position because the future has not yet been recognized, that speculative one because the market is irrational. All of that may occasionally be true. It also creates a swamp of self-deception. A simple two-fund portfolio gives you a much cleaner truth. Did I invest consistently? Did I keep costs low? Did I hold the line? Did I rebalance when needed? Did I let time work? Did I avoid panic? These are answerable questions, and answerable questions create better behavior. The world is already complex enough. Most investors do not need more complexity. They need more follow-through. I would much rather see a 58-year-old couple own 55% VTI and 45% BND, contribute steadily, rebalance once a year, keep an emergency reserve, and avoid making emotional mistakes than see them own 12 funds, 7 stories, 3 yield traps, and a permanent state of anxiety masquerading as sophistication. Wealth is not built by looking sophisticated. It is built by getting the big things right and staying with them. So what would I say to the person over 50 who feels late? I would say this. First, stop trying to rewind the clock mentally. It does not help. The energy spent grieving what you did not do at 30 cannot be invested now. Take inventory honestly and begin from where you stand. Second, respect the balance between growth and protection. Do not become so frightened that you guarantee decline through underinvestment. Do not become so desperate that you invite disaster through overexposure. Third, simplify. VTI for broad ownership, BND for ballast, a sensible glide path between them, automatic contributions, annual rebalancing, minimal drama. That is enough. Fourth, protect yourself from life. A retirement portfolio should not be your emergency fund. If you are constantly one surprise away from liquidating investments at the wrong time, fix that before you ask the market to carry your entire emotional future. And fifth, keep going. People over 50 often think in terms of catching up. I prefer a different phrase. Build forward, catching up carries shame. Building forward carries direction. A person with 15 years of disciplined investing ahead of him is not finished. A person with 20 years is certainly not finished. I have known people who built far more wealth in the second half of life than they ever imagined because they finally stopped trying to be clever and started being consistent. Consistency is underrated because it is not exciting enough for the modern imagination. It is still where most of the money is. So no, you do not need 40 years. No, you do not need a portfolio that looks like a graduate thesis. No, you do not need to guess the next superstar stock. What you need is a structure that can survive your fears, your impatience, the market's moods, and the ordinary hardships of real life. That is what these two funds can help create. A growth engine and an anchor, offense and defense, movement and stability, a machine simple enough to use and strong enough to matter, that is more than enough for most people. And in my experience, more than enough is a very profitable place to begin.